The stock market, as in the S&P 500, just hit 5,000 over the last couple of days in early February 2024. And if the S&P 500 is hitting 5,000, that's an incredible milestone. And we think the stock market is off to a really fast and furious start. You're listening to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Signe Lundholt.
And part of what I'm wondering is if this rally in the stock market is sustainable, because a lot of attention has been given toward the Magnificent Seven stocks, which are a lot of the popular big tech stocks like Amazon, Apple, Microsoft, Tesla, Nvidia, Meta, Google, Alphabet. So among those, a lot of hype may surround some of them, and some of them are just kind of doing business as usual and continuing to put up monster numbers. So what do you think is going on here, Sina, with some of the stock market now reaching this tremendous milestone?
It's a very good question also because it's not like I feel that in my everyday life that there's so much growth. I know that I'm not necessarily in the US, so maybe it's different in the US, but Denmark is usually following along with the US, and I don't really feel there's much growth from what I can hear. Also in the US with US companies, we just don't see a whole lot of growth for companies, that companies are growing, that revenue is growing, and then the stock market is growing. So to me, I'm just, I guess a little bit nervous about that fact that, it's like a locomotive going fast and where I just don't see growth growing so fast. What I experienced amongst my peers in the US and in Denmark is that people are saving more. They're not big spenders these days. And that means that growth for companies, when people don't purchase products and services, but keep the money and save and aren't making big purchases, what that means is that companies don't experience big growth. So that's where I am. What about you? What do you think?
I'm thinking that some of it is kind of hype. Like, I know some of these companies put up good earnings, except for Tesla. Tesla has been disappointing lately, and that's wiped off $400 billion off their market cap. Like, can you imagine? Tesla used to be at over $1 trillion market cap, and now they're at around 600 billion. They've kind of edged out of the top 10 in terms of market cap size. And even entities like Eli Lilly have gone up above Tesla for the time being. So I'd argue that Tesla is not even maybe part of the Magnificent Seven right now. It's sort of part of the shameful 11. I don't know. I'm just kind of joking. But with other companies sort of finding a way to thrive, we see companies like Berkshire Hathaway also reaching close to a top milestone of around $400 a share, which, during last year, it's not even been a year since there was that bank run crisis going on, and some people were selling off bank and insurance related stocks. Like Berkshire went down a little bit below $300 a share last year around March. So it's interesting how it's skyrocketed really. And, some of it could be justified. Like in a Berkshire's case, they're probably demonstrating how well they're doing, and they've been earning a lot of money from treasury bonds. Like, by the irony is, like you're saying, your friends are saving more, and kind of Berkshire was doing the same thing, but because they're a company and getting 5 to 6% for all their $150 billion of cash, investors are like, woohoo, like Berkshire's just collecting a lot more cash, and then they want to bid up the share price. And I'm sure Berkshire has been doing a lot more than just save money. Like, they're continuing to perform as a business in and of itself. And they've, I'm sure, had to raise prices on their insurance premiums because there's been a lot of disasters in America. So, there's been like epic floods in Southern California. It's been pretty rough. Like, I think I've heard it's over $11 billion of damage. So these companies really are needing to, perform. This is part of the Berkshire job of providing insurance, and then, kind of figuring out how much damage there was and how much they now need to charge people because of rising costs to fix things. So, for some, they find a way to stay resilient no matter what the economy is doing. So that's just a little bit of some of my high level thoughts, and it might sound a little bit rambling, but I have even more thoughts about some of the other companies I haven't even touched on. So, what do you think about, what you're seeing from some of the top American stocks?
You mentioned that it's the top 5% of the S&P 500, and S&P 500 consists of about 500 companies. So if they're driving that much growth, I'm thinking as an investor, if I was investing in a company and I had shares in a business and 5% of their, now I know it's totally taken out of context, but 5% of their business was in one thing, and that's where the whole company depended on that one thing, I would probably be potentially a little bit nervous. Of course, I would have to dig into the company. Maybe it's a good thing that they're very focused on their expertise, but at the same time, when you're so focused on only and concentrated on 5% of something bigger, then it's becoming quite risky. Now, I'm not necessarily an index investor and wouldn't necessarily invest in S&P 500 because I'm picking stocks instead of investing in the index. But if I was an investor in the S&P 500 index, I would probably be a little bit apprehensive about this fact, and also how come it's not more broad, the all the growth. That's what I'm thinking. I don't know, how about you? Is that something you thought, or how do you think about this?
It's definitely a little bit alarming that when you say that the top 5% of the S&P 500, that means the top 25 companies that are driving the majority of the S&P 500 reaching this new milestone of 5,000 points. So, if you think about which are those top 25 companies, it's all the obvious ones. People can look them up. It's easy to know who they are. And to your point of those top 25 companies, is it really justified that they are dictating the reflection of the market? Because we all know the S&P 500 is market cap weighted, which means that when people do invest in the indexes, most of their money is going to the top ones that have the biggest market share of that index. So it's all going to the usual suspects, like including the Magnificent Seven and the others in the top 25, because their share has been driving most of the performance of the S&P 500. Like, I saw some stats where it used to be the top 25 companies only had driven about 11 or 12% back in 1998 through 2014. And then in 2019, it went up to 17% of the index's was attributed to those top 25. And now in 2021, it went up to like 23%. And then in recent days in 2024, it's now at 27%. So you go from something that only had an eighth of an impact to more than a quarter of an impact of the overall index, which is a lot. So you can see that I think when there's a lot of hype, especially around companies like Nvidia, I think that, sure, there's excitement about AI, but it's starting to be a little bit exuberant, as if, I hate to say this, but it's as if Nvidia could be turning into a bit of a meme stock, if it isn't already.
That's true. It's grown quite a lot now. I haven't studied Nvidia and I haven't looked per se at the stock. Of course, I've seen all the craze about Nvidia. I've seen different forums where they share cases of, their case of why Nvidia is a good purchase in the future, etc. But I totally feel like you. It's like it's the new Tesla or something like that. Now the finance bros can't jump into Tesla. Tesla is not seeing the stock growth that it saw in recent years, and now Nvidia is it. That's how I feel about it. But that's coming from a place where Nvidia is outside of my circle of competence, so I haven't looked into the business. But I totally agree. When standing outside, it does look like it's a meme stock or the new thing that people that likes momentum trading jumps into. And the thing about momentum trading is not what I'm doing either. I'm not jumping on a stock where there's momentum. I prefer, just like Warren Buffett, his rule number one is don't lose money, and rule number two is never forget rule number one. So for me, it's not the kind of risk or gambling that I want to take, I'm not a gambler. So I want to invest in a business where I know about the business and I've already done some work to ensure that it's a healthy business, just like Buffett, he wants healthy businesses. So do I. And I have my way of finding out what's a healthy business. Are they competitive? And that's just where with Nvidia, that's not why people are investing in that stock. It's because it gained momentum. And what I think is happening is a lot of gambling going on, probably a lot of options trades that are the highly risk kind of options trade where people are gambling on Nvidia's future. So I absolutely agree on that. And I also think that this thing about just jumping into the popular stocks instead of finding gold that's undervalued is a big mistake that people are making these days. There's so many things going on about on social media about which company you should invest in. And maybe that's something we could explore in a future episode. But I really think that people need to pause a little bit and do some due diligence, in my opinion. So, listeners, this is to you. If you're thinking about jumping on a stock that you hear a lot about, oh, it's only going up, I really recommend to listen to this podcast from the beginning and get Michelle and I's tips on how to find a wonderful, healthy business the Buffett way. So
Yeah,
that was
and
a
of
lot of chatter. Michelle, do you have anything to
oh
add?
yeah, for sure. I mean, I agree on all points, and to emphasize what you're saying about how people could be gambling, if you compare even just a couple of some of these big tech stocks, like two of the biggest, like Nvidia has a $1.78 trillion market cap, and Apple is a little under 3 trillion. And when you look at those companies, like Apple's been at the top for a long time, and Nvidia has been rushing up in recent years. So a lot of the semiconductor stocks hit a low in October of 2022 when Nvidia was trading at about $110 a share. And it's gone up 6.5 times since then. And since early 2024 started, it's gone up another 50%. So you could have made 50% if you had invested in Nvidia at $475 a share, and now it's at $720 a share, which is just insanity to me. So you can tell compared to something like an Apple, which hasn't done anything since the beginning of the year. Like it's kind of gone from 185 to about 195 and back to $188 a share as of February 9. So we're looking at this on a nice Saturday morning, at least in my time. I know it's Saturday afternoon for you, but just to paint that picture of how big of a difference that is, you can see how much hype is surrounding Nvidia. And it's not the same with all of the big tech. You can clearly see that the same irrational exuberance, maybe that's being attributed to Nvidia, is not happening to Apple. In fact, Apple slipped a little bit because they missed some earnings expectations. So maybe, some of these I would look into and kind of think, is there a potential opportunity when you see others that are flying so high and others that are kind of just continuing, but not really doing that spectacularly? Maybe that's a cause to investigate. So, of course, when you listen to this podcast, we're not recommending anyone buy or sell anything. So, we hope everybody knows that this is just for educational purposes, but it should make you want to stop and think, what justifies a company to have in a little bit in less than 40 days have skyrocketed 50%? Like, does that make sense? Like, a 50% return is insane, even just for 1 year. And is that realistic for a company to sustain that in just 40 days out of a year? There's still another 320 days to go. Like, what are we expecting Nvidia to do, to continue to skyrocket to the moon? I doubt it. If anything, sadly, it's likely that the stock price is going to crash and burn at some point. So everybody who's piling in at the top of whatever the price point will be, they will be considered what's called the greater fool, because all that a lot of people are doing at this point by piling into a stock like this that's turned into a meme stock is they're waiting for someone to be more foolish than them to buy it at the next higher price. And then at one point, a lot of people are going to bail, and semiconductor stocks someday will be a little bit unsexy again, like they were in October 2022, because semiconductors are a cyclical business. So, a lot of people are so excited about AI, and sure, there's a lot of promise, but there's also a lot of cautionary tales like the rise of deep fakes and how is that going to impact the American election this fall. So, a lot of things to think about with the both the promise and the danger of AI. So, it's not like any of these companies are immune to some of these trends in technology and society. So, just some things to keep in mind as you're trying to invest, and you know for you to realize when people are being foolish, and how, even though you don't want to miss out, but you don't want to participate in something that you think is probably going to be a sinking ship at some point.
Yeah, and what I think about when you're saying this, Michelle, is something, like the tulip craze. We've seen it over and over again where people jump on a hype. And most recently, it was the dot-com era around the year 2000, where all internet companies, people piled their money into internet companies. It was the new thing, the new craze. And in my opinion, that's exactly what we're seeing with AI. Whenever a company mentions AI or has anything to AI, we see that startups is benefiting from it, from the point where venture capitalists, VCs invest in companies that says anything about AI, to the stock market, where any company that mentions that they do any kind of AI, people will pile their money into that company without even thinking about, is this correct, or did they just create a GPT for themselves that's not really that advanced or something like that. It is, in my opinion, so much like the dot-com craze back in 2000. And why is that dangerous? Well, there was the dot-com crash, as it's called, and I can't predict the future. I don't know if a crash is coming. Maybe it doesn't. Maybe it just continues to skyrocket up there. But what happened in 2000 was that it became clear that not all of these companies, all of these internet companies, were growing at the rate that the stocks were. And then people started selling and getting fearful about what they had invested in. The picture that was painted wasn't as pretty as some of the companies made it look like. And that's when investors became fearful, sold their stocks, and then the market crashed. And that was because of, all of a sudden, the picture became clear. It wasn't as big a grow market as people thought. And we've seen it over and over again in history. It's time we learn.
So, I mean, not to get too into macroeconomic predictions or anything like that, because nobody knows what the future will entail, but it is a little bit of a cautionary sign. Like Warren Buffett has, on behalf of Berkshire Hathaway, they seem to be a little bit more conservative still. You don't see someone like Warren Buffett or his investing lieutenants buying all that much right now. So that should kind of make you think again about some of your own investing decisions. Like, if the best investor of all time is not rushing out there to buy Nvidia, why why should we be buying Nvidia, right? Like, I mean, it's something like that. Like, not to rag on Nvidia, but it's just an example of, you have to discern when something actually is having an appropriate value and when it's just insanity. It's sort of like concert ticket pricing. Like, if you first hear about a concert and you buy your ticket in advance, and you buy it at a reasonable price, it's probably a normal price. But then the more that people hear about the concert and it's coming up, maybe Taylor Swift is playing it, then everybody gets crazy, and they buy up the concert tickets and they try to sell it and mark it up, and they try to get a lot of people to pay more for those concert tickets. But if you are getting in that crazy point, then you realize, like, this is just insanity. Like, maybe find another date at which Taylor Swift is performing where the ticket prices are reasonable and not like just crazy just because it's 2 days away, and you hear all your friends being like, we want to go to the Taylor Swift concert, and you're like, okay, I'm going to spend $2,000 on a ticket. But it's like, is that really realistic? Like, I doubt it. So, you know, sometimes, I don't know, people probably even pay more than $2,000 for, some of these really popular concert tickets that some of these incredible artists like a Taylor Swift might be putting out there. But we should try to take a step back and think about what makes sense, because, okay, sure, it could be an event of a lifetime. Maybe it will be the one in a lifetime chance you have to see popular artist and that will be it. But in the stock market, it's not the same. Like you will have more opportunities if you can just value a company correctly and wait patiently. You will see them again. Unlike some music artists that sometimes they get too old and then they stop going on tour. So sometimes you miss your chance with an artist. So I get it. But with stocks, you usually have a chance to get in. Like Coca-Cola had already been trading for over 100 years before Warren Buffett had gotten into it. So if you think about that, you can get into stocks even if it's been 50 years since they've started.
What we're talking about here is it safe right now to invest, and how do we feel about the S&P 500 reaching new heights, then where it's like, we're questioning how come it's happening and being a little bit cautious and suspicious about what is going on. So that's what you can hear from us, is that we're definitely questioning what is going on. And at least for myself, I don't quite understand it when I look at how companies are growing. And what I'm also seeing in the groups on social media now, I follow along in a female investing community with a lot of female investors or traders. There are all kinds of different women that are shareholders in there and trying to learn how to invest. And I see the frustration from some of the people that are getting frustrated about other people trying to say, oh, but this Nvidia never goes down. It's never going to go down. It's only going to continue to grow. And some of the newcomers jumping on that, oh, okay, so they believe that's true. And then other people are sharing their frustration about all these rumors and all these things that are being thrown around on social media, and admins in there also trying to say, be careful right now, like don't jump into stocks that people are advertising. So there is definitely some kind of movement these days about people rushing in, a lot of newcomers rushing into the stock market and believing that, okay, because I heard something over here, that Nvidia is the next big thing, and rushing into it. And it is like you're saying, they could end up as the greater fool of being the last person to buy into the stock, and then the market is going down. And that's really sad, especially if you're a new investor and hopefully would have a long life investing in stocks and accumulating wealth for you and future generations to come. So to just pause. And actually, right now, in my opinion, because everything is so crazy out there, it's the perfect time to learn. It's the perfect time to listen to this podcast and starting to be interested in how does Warren Buffett invest. It's the perfect time, because then you don't have to participate in all that craziness that's going on. What you can focus on is your investing practice. Like I know that comes from Danielle Town, where she's talking about it's a practice, like a yoga practice. It's something that you should continue to practice, and you can start today and just tune out all that craziness that's going on, which is craziness in my opinion.
Indeed. I mean, it's not to say that there aren't some stock opportunities, but we all just have to work harder. It's not going to be an obvious softball throw to us. Like they're going to be curveballs and all these kinds of pitches that we just need to focus on, like what Sina said earlier, our circle of competence. So, even if you look at Warren Buffett and Berkshire Hathaway's investing activities lately, I haven't seen their 13F filing of what their equity holdings were for the fourth quarter of 2023, but just based on the third quarter of 2023, they only had 4 buys and they had about 13 sells. So if you think about that, it's sort of not encouraging that out of all of that, they're way more bearish because they're selling off even good companies like Amazon or Markel. Surprisingly, they're not as bullish on some of these stocks that you would think are, pretty good companies. That, like, why would Berkshire sell them? And maybe the reason is there could be a few reasons. Like some, maybe they think it's overvalued and they want to reallocate the money to something else, or they think the companies have changed and they no longer are as confident about their investment in some of these companies. So it's sort of quizzical how some of these companies can change over time. And so I would try to compare notes with some of the best investors, like like we've talked about before, you can see what some of these super investors own on dataroma.com. I frequently go there because they portray equity holdings of the best investors in a very simple way. So you can keep tabs on how are some of the best investors investing right now. And other some of our favorite super investors like Guy Spear, he hasn't bought anything in American equities in like more than 2 years. It's interesting how he's just staying put. So he's another really good investor to see what he's up to. And he's been a little bit under the radar. Like, so, the American stock market continues to seem overvalued. So it's kind of unfortunate, but just when everybody thinks it's a strong economy and like everything should be getting better, but a lot of consumers still feel a little bit not so confident. Like they, I think people are still reeling from inflation being high, at least in America. And a lot of the prices are just permanently up there. Like some things that used to be sort of normal price, like for example, I think used to be able to find ground beef at, say, somewhere between $2.50 to $3 a pound, and now it's easily over $5 a pound for ground beef. And like that's just a normal everyday grocery thing, and it's gone up like double. So you kind of wonder, like, when consumers have to spend, a lot more on everyday goods, does that really make them feel confident about what people are saying is a strong economy? Like, sure, inflation has come down a little bit, but it hasn't gone back to what it was before the pandemic. So it's a little bit disconcerting because consumers don't feel great. Like your point earlier, Sina, a lot of us want to just save our money. We don't feel so confident about the future, and maybe that hunch is worthwhile to listen to that gut feeling of saving our money in case of a rainy day, right?
Absolutely. And yeah, it's been really interesting to hear what you have had to say here, Michelle, because very important for people to reflect and think about what is going on and how is their own patterns right now, and does that resonate with the what's happening in the stock market. And I also want to say, because we're coming towards the end of the episode and you talked about data aroma. So this podcast comes out on February 13th, and on the 14th, so Wednesday, the next reports comes out. So from the fourth quarter of 2023, you can see what Buffett invested in tomorrow, Wednesday, or whenever you're listening to this episode. It could be later, but that's when the report is coming out from where we are right now. Do you have any closing remarks, Michelle?
Yeah, definitely check that out and see, look at these trends of what super investors are investing in as they come out with their latest equity holdings. It could be useful. Like you could get some ideas from it, and you should think twice if you see someone selling more Amazon for some reason. Like, why would a Berkshire Hathaway be selling Amazon? So think about that. Maybe Warren Buffett and his investing lieutenants are wrong. It doesn't mean that they're always right. That just because they're being bearish on Amazon doesn't mean that you should be. Maybe that means it's a fantastic buying opportunity. Who knows? But it does make you think. So definitely keep all that in mind. Like you said, thank you, Sina, for mentioning. We're going to find that out soon. So I'm excited about it. I hope everyone will have fantastic Valentine's Day or had it if it's already passed now when you're listening. And, you know, let's try to help each other be better investors as we go along.
Absolutely. And with those wise words, Investing Mastermind podcast is over for today. We'll be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.